Here is the deadline. A lot of investors are about to walk straight past. If you realised a $20,000 capital gain this year and you fail to lock in matching losses before the 30th of June, you could pay up to $9,000, more tax than you needed to, according to ATO capital gains rules and the marginal rate schedules. That is not a penalty, it is purely a timing mistake. So here is what is actually happening. Capital gains you make on shares, managed funds, or investment property get added to your assessable income and taxed at your marginal rate, according to the ATO. To reduce that 2025-26 bill, any capital losses have to be realised, meaning the assets actually sold before the 30th of June. Sell them on the 1st of July and they only count for next financial year. And this matters because the rules are not flexible. The ATO states that current year capital losses must be applied against current year gains, and you cannot choose to defer to a later year any amount that can be applied this year. So if your gains land in 2025-26, your offsetting losses have to land in 2025-26 too. Miss the window and you pay full freight on this year's gains, with relief only available against future gains. This hits anyone who has booked a gain this year while holding investments sitting underwater. On a $20,000 gain left unoffset, a higher income investor on the 37% rate pays around $7,400 in CGT, according to the ATO marginal rate schedules. At the top, 45% bracket that climbs to $9,000. Realising matching losses can wipe that to zero. Take Sarah, a Sydney marketing manager on $160,000. She had a $20,000 share gain and a $15,000 unrealised loss on a tech ETF. By selling that ETF before 30 June, her net gain dropped to $5,000 and her CGT fell from $7,400 to $1,850, a $5,500 saving from one trade. Here is the detail buried in the rules. If your losses exceed your gains, the surplus becomes a net capital loss that carries forward indefinitely, according to the ATO. That sounds generous, but there is a catch. A carried forward loss can only ever offset future capital gains. It cannot reduce your salary or other income. So the real value still comes from matching losses against gains in the same year wherever you can. So here's what to do this week. First, pull your holdings from your broker or registry and flag everything sitting at an unrealised loss against its cost base. Second, decide which losses you're comfortable realising and place sell orders early enough that the trades settle within the 2025-26 financial year, not after. Third, keep all the records, and if your losses exceed your gains, report the net loss at label 18 vis so it carries forward per the ATO instructions. Do not leave this to the 29th. It is the settlement date that determines the financial year, not the day you click sell, so build in a few days of buffer. A trade placed too late that settles in July counts for 2026 to 27 and does nothing for this year's tax bill. And keep one eye on the horizon. From the 1st of July 2027, the Budget 2026-27 papers confirm the 50% CGT discount is replaced with cost-based indexation plus a minimum 30% tax rate on gains, according to Treasury. That makes realising gains under today's discount system meaningfully cheaper. For Sarah, timing a large property sale before that date instead of after could save tens of thousands, so this year's planning is part of a much bigger picture. This is the kind of deadline that costs people real money simply because nobody told them in time. Subscribe to the fine print and we will keep you across every CGT change, every cutoff, and every move worth making before it closes. Remember, this is general information only, not financial advice, so check your own situation with a registered tax agent